When an automaker goes bankrupt, your warranty dies with it. No parts, no service, no software updates. Just a $63,000 paperweight in your driveway. This summer, 5 major car brands are fighting for survival while still running commercials like nothing's wrong. One already filed legal papers admitting they might not exist next year. Canadian dealerships are still taking your money anyway. Here are the 5 brands you need to avoid. Let's start with a brand that just got served legal papers by our own government. And yes, this actually happened. Chrysler. Here's something most Canadians don't know. In December 2025, Industry Minister Melanie Joly issued Stellantis, Chrysler's parent company, a formal notice of default. The Canadian government declared them in breach of taxpayer-backed financial aid agreements. This isn't some minor regulatory slap on the wrist. This is the country that saved Chrysler from bankruptcy in 2009, now threatening legal action against the company we rescued. The backstory is ugly. Canada gave Stellantis over $500 million in subsidies to keep production in Brampton, Ontario. The deal was simple. Take the money, keep the jobs, build vehicles for Canadian workers in Canadian plants. Instead, Stellantis moved Jeep Compass production to Illinois and put the Brampton assembly plant on operational pause. 3,000 Canadian auto workers got layoff notices. The jobs Minister Joly was promised would stay in Canada vanished across the border, while American plants celebrated new investment. "We were there for the company in 2009 to pull it back from the brink of bankruptcy," Joly told Parliament. "Now we expect you to be there for Canadians. Anything short of fulfilling that commitment will be considered a default under our agreement." The Canadian government reduced Stellantis and GM's import quotas as punishment for cutting Ontario production. That's unprecedented. Our government is actively penalizing automakers for abandoning Canadian workers. When was the last time you heard about that happening? But Stellantis isn't being there for anyone. The company just posted its first annual loss in history, $26.3 billion gone in 2025. Not million, billion. They're writing off failed electric vehicle investments, suspending shareholder dividends, and actively reviewing which of their 14 brands deserve to survive. CEO Antonio Filosa admitted publicly that 2025 reflected the cost of overestimating the pace of the energy transition. Chrysler is at the top of that kill list. The entire brand consists of 2 vehicles, the Pacifica minivan and the Voyager, which is basically a stripped-down Pacifica sold to rental car companies and fleet buyers. That's the whole lineup. The Chrysler 300, the last sedan that actually represented what this brand stood for, was killed in 2023. The Airflow EV that was supposed to save the brand and prove Chrysler could compete in the electric future got canceled mid-development because it was already outdated before they could build it. Former CEO Carlos Tavares publicly warned that Stellantis brands could disappear by 2026. He didn't name Chrysler specifically. He didn't need to. Everyone in the automotive industry knows a brand selling only minivans while its parent company hemorrhages billions isn't long for this world. Chrysler turns 100 years old in 2025. It might also be celebrating its funeral. If you're financing a Pacifica right now, you need to think carefully about what happens when the company behind your warranty is fighting for survival and defaulting on agreements with our government. Parts availability, service network, software updates, resale value, all of it depends on Chrysler existing when you need them. And speaking of Stellantis brands in trouble, the next one is even more popular in Canada, which makes this even more concerning for Canadian drivers. Dodge. Dodge built its reputation on being unapologetically American. The Challenger, the Charger, the Hellcat, vehicles that told efficiency regulations to get lost. For a generation of Canadian enthusiasts, Dodge was the brand that didn't compromise. Now Dodge is fighting for survival under a parent company that's imploding. Stellantis dealers entered late 2024 with 131 days of Dodge inventory sitting unsold on lots. For reference, healthy dealerships target 60 days. That's more than double the normal inventory just sitting there, depreciating, while interest payments pile up and dealers wonder if they'll survive the year. The gas-powered Charger and Challenger that defined Dodge's identity were killed in 2023. Leadership bet everything on electric replacements. The Charger Daytona EV was supposed to prove muscle cars could go electric without losing their soul. The market disagreed. Through Q3 2025, only 7,400 electric Chargers were sold, compared to hundreds of thousands of gas versions in previous years. Customers rejected the pivot so completely that Stellantis is now scrambling to bring back gasoline engines. The Charger 6-pack, the resurrected Hemi 5.8, but the damage is done. Windsor Assembly Plant, which builds the Charger and Pacifica for the Canadian market, has been on a roller coaster. Workers got called back for third shifts, then laid off, then called back again as Stellantis figures out what they're even building anymore. The uncertainty is destroying morale and making Canadian auto workers question whether their jobs exist next month. Dodge isn't dead yet, but when your parent company loses $26 billion and starts cutting brands, even strong names become vulnerable. Stellantis is actively reviewing all 14 brands. The decisions being made right now in corporate boardrooms will determine whether Dodge dealerships across Canada stay open or become empty lots. If the American brands are struggling this badly, you'd think Japanese reliability would be a safe bet. But the next brand on this list proves that even decades of reputation can't save you from bad decisions. Nissan. Walk into any Canadian parking lot and count the Nissan badges. The Rogue, the Sentra, the Pathfinder, the Murano. For millions of Canadian families, Nissan meant one thing that mattered above all else: affordable reliability. The Rogue became one of Canada's best-selling compact SUVs for years running. The Sentra got university students to campus and back through February blizzards. The Pathfinder carried families through brutal prairie winters without drama. Nissan wasn't flashy. Nissan wasn't exciting. Nissan was dependable. And for most Canadians trying to balance a car payment with mortgage rates and grocery bills, dependable is exactly what they needed. Today, Nissan is fighting for survival, and internal sources are saying they have 12 to 14 months left before bankruptcy becomes a genuine possibility. In November 2024, a senior Nissan executive told the Financial Times something that should terrify every single Nissan owner in Canada. Without a major investor or merger partner, the company cannot survive the debt obligations coming due in 2026. That's not analyst speculation from someone trying to short the stock. That's not internet doom posting from automotive forums. That's an internal admission from a senior executive who has actually seen the company's financial books. The numbers backing up that warning are catastrophic. Profits for the 6 months ending September 2024 crashed 94% compared to the same period in 2023. Let that sink in. 94%. They went from healthy operation to emergency mode in a single year. The company actually lost money on every vehicle sold and only showed narrow overall profits because of their financing division. They made money on car loans, not cars. In response to the bleeding, Nissan announced 9,000 layoffs globally and cut manufacturing output by 20%. That's not trimming fat. That's not efficiency improvements. That's emergency surgery on a patient who might not survive the operation. Honda and Nissan tried to merge. It was supposed to be the salvation story, a $58 billion combination that would have created the world's third largest automaker with the scale to compete against Tesla and Chinese manufacturers. By February 2025, those talks completely collapsed. Honda wanted Nissan to become a subsidiary. Nissan's CEO Makoto Uchida refused. Pride killed the deal that might have saved both companies. Now Nissan is desperately searching for anyone willing to invest. Foxconn, the electronics manufacturing giant, has made approaches. Banks have been contacted. Strategic partners have been courted. Nothing has been signed. The company that revolutionized affordable electric vehicles with the Leaf, the brand that proved EVs could work for regular families, might not exist in 2 years. For Canadians who drive Nissan vehicles, here's what collapse actually means in practical terms. Your warranty becomes a promise from a company that may not exist to honor it. Dealer service networks shrink as locations close because they can't get parts or support from a bankrupt parent. Parts become scarce and brutally expensive as supply chains break down. Software updates stop entirely, and your resale value craters overnight because nobody wants to buy a vehicle from a dead brand. But Nissan isn't the only Japanese brand in trouble. The next one is tied directly to Nissan's fate. When the parent company falls, the luxury division falls with it, and it's already halfway down. Infiniti. Infiniti was supposed to be Japan's answer to Lexus, Nissan's premium brand. The G35 became a cult classic that proved Japanese manufacturers could build true driver's cars. The QX80 went toe-to-toe with the Escalade. For Canadian luxury buyers who wanted something different from German defaults, Infiniti offered genuine value with Japanese reliability. Those days are gone. In 2017, Infiniti sold 153,000 vehicles in the United States. By 2024, that number collapsed to 58,000 units, a 62% decline that shows no signs of stopping. Canadian sales have followed the same trajectory. The brand that once challenged BMW for driver engagement is now struggling to justify its existence. The response has been retreat on every front. Infiniti shuttered standalone showrooms across North America, folding back into Nissan dealerships as a cost-cutting measure. Models are disappearing from the lineup. The QX50 and QX55 ended production in 2025. The Q50 sedan is already gone. What remains is a skeletal lineup of 2 SUVs, the QX60 and QX80, competing in segments where German and Korean brands dominate. Here's the part that should genuinely concern Canadian Infiniti owners. Your brand's survival is directly tied to Nissan. Infiniti doesn't have independent factories. doesn't have separate engineering teams. Everything flows through Nissan's corporate structure. When internal sources say Nissan has 12 to 14 months to find salvation, they're saying the same thing about Infiniti. CVT transmission problems plagued earlier models and destroyed the reliability reputation that was supposed to separate Infiniti from German competitors. Recalls for engine failure, power loss, and brake defects shattered buyer confidence. Resale values cratered. Today, used Infiniti vehicles depreciate faster than almost any other luxury brand in Canada. Infiniti keeps promising new models and future EV lineups, but promises mean nothing when the parent company is desperately seeking investors to avoid bankruptcy. If Nissan goes down this summer, Infiniti goes down with it. Every warranty, every service agreement, every promise of support, gone. The number one brand on this list is different from the others. They didn't just show warning signs, they actually filed legal documents admitting they might not survive. And they're still selling cars to Canadians who have no idea. Polestar, the number one brand on this list, is different from all the others. They didn't just show warning signs that analysts had to interpret. They didn't just have bad quarters that needed explaining. They actually filed official legal documents admitting they might not survive. And somehow, they're still selling cars to Canadians who have absolutely no idea what they're buying into. In September 2025, Polestar did something unprecedented in the automotive industry. They issued an official going concern warning. For anyone who doesn't speak corporate legal language, let me translate that into plain English. A going concern warning means the company publicly admitted to financial regulators that they have substantial doubt about their ability to continue operating as a business. Polestar told the world they might not exist next year. Then they kept their dealerships open and continued taking orders from Canadian buyers. Let me walk you through how catastrophic this situation actually is, because the numbers are almost hard to believe. Polestar went public through a SPAC merger in 2022 with shares trading around $13. Investors were excited. Here was Volvo's electric performance brand backed by Swedish engineering credibility and Chinese manufacturing scale. The future looked bright. Today, those same shares trade for roughly 22 cents. 22 cents. That's a 96% destruction of shareholder value in 3 years. If you invested $10,000 at the peak believing in Polestar's electric future, you'd have about $400 left today. The company had to execute a 1-for-30 reverse stock split just to avoid automatic delisting from NASDAQ for falling below the $1 minimum share price requirement. The financial bleeding is staggering even by automotive industry standards where losses are common. Polestar has accumulated approximately $8 billion in cumulative losses since the company was founded. $8 billion burned trying to compete with Tesla, trying to establish a brand, trying to build a dealer network, trying to create vehicles people would actually buy. They posted over $1 billion in losses for Q2 2025 alone. Then they took a $739 million impairment charge on the Polestar 3 SUV because tariffs and weak demand destroyed their sales projections before the vehicle even had a chance to gain traction in the market. The cuts came fast and brutal after the going concern warning. Polestar laid off 15% of their global workforce. They shut down their UK research and development facilities entirely, letting 130 engineers go in a single gut-wrenching announcement. One departing executive wrote on LinkedIn about watching nearly 7 years of hard work and dedication gradually being dismantled. When your own employees are publicly mourning the death of their life's work, you know things have gotten bad. Then came the final blow that ended any hope of recovery. Volvo walked away. Polestar was supposed to be Volvo's electric performance brand. That partnership was everything. It provided stability when losses mounted. It provided shared engineering resources that a startup could never afford alone. It provided credibility, with consumers who trusted the Volvo name even if they'd never heard of Polestar. When Volvo withdrew financial backing, Polestar lost their safety net. Now they're entirely dependent on emergency funding from Geely, their Chinese parent company, just to keep the lights on. In late 2025, Polestar secured $300 million in new financing and converted another $300 million of debt into equity. Let me be clear about what that means. That's not growth investment, that's not expansion capital, that's life support. That's a company doing whatever it takes to survive another quarter while desperately hoping something changes before the next crisis hits. For Canadian buyers considering a Polestar, here's what you need to understand about what you're actually purchasing. When you buy a vehicle, you're not just buying a car. You're entering a long-term relationship with a company. You're trusting them to honor warranties that extend 5, 7, even 10 years into the future. You're counting on them to provide over-the-air software updates that keep your vehicle's systems functional and secure. You're depending on their dealer network for service and repairs. You're relying on their parts supply chain when something breaks. Polestar has publicly stated in legal filings that they might not survive. The going concern warning is an official admission of potential failure filed with financial regulators. If you buy a Polestar today and the company collapses next summer, what happens to your warranty? What happens when you need a replacement part that nobody manufactures anymore? What happens to the software updates your vehicle needs? What happens to your charging network access agreements? These aren't hypothetical questions designed to scare you. The company's own leadership raised them when they filed that warning. They're telling you they might not make it. The question is whether you're listening. Here's what every Canadian car buyer needs to understand about this summer. The automotive industry is experiencing a shakeout that hasn't happened since the 2009 financial crisis. Parent companies are losing tens of billions of dollars. The Canadian government is issuing default notices to automakers who took our subsidies and broke their promises to Canadian workers. Electric vehicle strategies that cost billions to develop are being abandoned because customers rejected them. Assembly plants in Windsor and Brampton don't know if they'll be operating next month or sitting idle next year. The average new car in Canada costs $63,264. Finance that over 8 years at current rates and you'll pay $955 every single month. Over the typical 9-year ownership period that Canadians now keep their vehicles, you'll spend nearly $140,000 on that car between payments, insurance, gas, and maintenance. $140,000. That's too much money to bet on a company that might not exist when you need them to honor a warranty claim. Before you sign any financing agreement this summer, do your homework beyond the spec sheet and the test drive. Check the parent company's financial statements. They're public. Look at their loss reports. Understand what a going concern warning actually means for your ownership experience. Search for default notices and government disputes. Look at market share trends over the past 5 years. Ask yourself whether this company will exist in 2030 when your warranty matters. Some of these brands will survive. They'll find investors at the last minute. They'll cut costs ruthlessly. They'll restructure operations and emerge from this crisis leaner, meaner, and ready to compete. But others will run out of cash, file for bankruptcy protection, and leave hundreds of thousands of Canadian owners stranded with orphaned vehicles that nobody will service, nobody will warranty, and nobody will buy. The question isn't whether there will be casualties in the automotive shakeout. There absolutely will be. Multiple brands on this list won't exist by 2027. The question is whether the vehicle you're financing right now puts you on the winning side or the losing side of that shakeout. Do your research, ask the uncomfortable questions, and choose carefully, because the car you buy this summer might become a $63,000 paperweight sitting in your driveway by next winter if the company behind it disappears. And based on what we've covered today with these 5 brands, disappearing is a very real possibility. Canada, consider yourself warned.